Okay, I wanted to make this video on ATM, ITM, and OTM so people can get a basic understanding of Nadex binary options. We've had some questions in our live trade room about this topic, so I wanted to get this video out. This video is presented by the Option Traders Group, and you can check us out at www.theoptiontradersgroup.com. Before we get into the material, I did want to put up this disclaimer here that discusses risk. Please take a second to look this over, and I will get into the material in just a minute. Alright, let's get started. Okay, so ATM, ITM, and OTM, and this is just a quick overview of what they mean. I'm going to go more into detail on each one of these categories in just a minute. But the ATM is the at the money, the ITM is the in the money, and the OTM is the out of the money. So let's discuss these contracts and where they are on an option chain. Before we get into that, I did want to talk about something that's very important, that is how the Nadex binary option works. Okay, so each contract on Nadex is worth $100. The contracts are all or nothing, so they're either going to be in the money or they're going to be out of the money. They're going to win or they're going to lose. There is no gray area. Nadex does offer a variable payout vehicle or instrument, and that is called the Nadex spreads, box spreads. But this video will be mainly on the binary options, or the all or nothing positions that they offer. These contracts either settle at 0 or they settle at 100. So if the price finishes below your strike at expiration, it will settle at 0. If price is above your strike at expiration, it settles at 100. So if it settles at 0, it settles out of the money or worthless. Or if it settles in the money, it will settle at the 100. Okay? So at the bottom I wrote, it's extremely important to understand this. And if you don't understand this portion, don't go any further into the presentation until you wrap your mind around this. I mean, there are some basic concepts here. They're $100 contracts. They settle all or nothing, and they settle at 0 or 100. Okay, this is the basis for the information to follow here. Okay, so let's start with the at the money contract. So I have my Nadex binary option chain up here, and the gray area that I have highlighted in this region here are the at the money contracts. Okay, and they are the the contracts that are trading closest to the underlying asset that you are trading on. Okay, and you can see on the chart here, I put the strikes here that I have highlighted here. You know, the 1.0880 is right here. The 1.0860 is right here. Now, oftentimes, if you look at a chain, there'll only be one strike level that is the at the money. Now, what you're looking for at the money is the ones that are trading closest to $50. Now, we talked about the contracts being 0 and 100. 0 to 100, 50 is right in the middle. Okay, that is the at the money strike. As you can see, the ones I got highlighted here are 52, 47, 58, and 40. So they're right around $50. Those are your at the money strikes. Now, the reason why I have 2 is because price is right in between the 2 strikes. It's not at one or the other. If it's right on one, that's when you're going to get the exact 50-50, or as close to it as you can. Okay? But being that this one is down below that strike and above this strike, it's in between, that's why I got both of these, because the price is right in between here. See that? Price is trading right in between. So that's why I have the 2 highlighted in this example. Now, the odds of this trade turning out profitable for you is really 50-50. Now if you choose, say you choose this strike right here, it's trading pretty much right at that strike. Now there's a 50% chance it can be there, and there's a 50% chance it could be there. Okay, so you have a 50-50 chance. Now your risk reward on these, okay, you're looking to get as close to 1-to-1 as possible. So if you sell it for 50, okay, you can make 50. You know, if you buy for 50, you can make 50. So you can try to get as close to 1-to-1 as possible. You're not going to get the perfect 1-to-1 on these because we're going to be setting take profits. And also, as you can notice on the chain, they're not the perfect 50-50. They're off by a few dollars. Okay? Very seldom are you going to see a perfect 50-50 here. Okay? So you're going to be settling for, you know, something like 52 or 47 or something like that. Okay? So I talk in nice round numbers for the example so you grasp the concept. Real world, it's going to be a little off by a few bucks. Now this is a directional trade. You need to have a bias here, okay? You need to say, okay, well, it looks like it's bouncing off of this support. You know, I'm gonna buy this, and I think price will be above here at a certain time. Or it's bouncing off a resistance. I think it's going to be below here at 11 a.m. You need some type of bias. There is some skill required here, and the skill needed is a mid to high level, I would say, on these. Just because I say mid to high, because price is at the strike, so it doesn't have to go very far for it to go in your favor here, okay? Versus some of the other, like out of the money, which we're going to talk about a little bit, price is going to have to travel a lot further, so you're going to have to be pretty good on an out of the money, you know, at picking a direction. Here, you still have to be good, but not as good as the in the money, because it doesn't have to go very far. As you can see, say you bought this strike, price only has to go a few ticks. It could finish one tick above here, and you'll make your $50 on that. Okay, so that's how that works. There is no stops required on these trades because they are about 1-to-1. But if you do want to use stops, the way to use them on an at-the-money play is, well, one, say you bought this strike right here. You can put a stop right here, and if it does fall down pretty quickly, I mean, it's going to stop you out probably with a $25, $20 loss. It just depends on how quickly it comes down there. Okay. Now the other way, and I like to use them, is if you do an at the money, you buy this strike here. Okay. Price moves in your favor. Once it gets up in your favor, I put a stop right at this strike right here. Now keep in mind, you're buying the strike for about 50. Okay. Now say price comes up like this, crashes back down. You have a stop on. It hits your stop. It takes you out of the trade. Now, what is price when that comes back down here? What is the price of your option if it comes back to that strike? $50. It's at the money, right? So you bought over here for about 50. Comes up, comes back, stops you out at 50. What did you lose on that trade? Nothing. It's really a zero risk trade at that point. Okay? Now again, those are perfect numbers. You're not going to get the perfect numbers. It's not going to stop you out exactly 50. It's going to stop you out, you know, a few dollars worse than that, because we're going to be using Nadex indicative price for the stops, and I'm going to get into the Nadex indicative price a little bit later on in the slides here. But again, for the example, it's going to get you in. You're going to buy at 50. You're going to get stopped out at 50. Your risk is really zero at that point, and your reward would be $50 if it does finish in your favor. So you can get yourself into a no risk situation on these pretty quickly. Okay. So, and now on the take profit end of things, now that's if you're using the stops. I mean, again, it's not completely recommended that you do because it is a 1-to-1 trade, so it's not bad risk reward. Okay. Now the take profits should always be used, I feel, on these, because no matter how good you feel about the trade or whatever, you still only have a 50-50 chance right here, 50-50 chance of this trade working out in your favor. So if it does go in your direction after you bought this strike, say, and it goes your direction, it's smart to take profit on these things. Now it's going to hurt your 1-to-1 a little bit, but you're taking a profit. Okay, so your take profits if you are selling, say we sold that strike, would be $5 or $10. Okay, sell for 50, buy back at 5 or 10. Okay, on the other side of it, if you're buying, it's going to settle at 100 if it goes right. So you buy at 50. You sell at 90. This is supposed to be 90, not a 5. you sell at 90 or 95. So you buy at 50, you sell at 90, 95. So you're looking at a $45 or $40 profit on either side of that. Okay, so 5 and 10 or 90 and 95. Take profits are pretty much essential on these. Again, you only have a 50% chance of your desired outcome here. Going to get more into the probabilities in just a second. Okay, so the in the monies, and one of my favorites here, are a little bit different. As you can see, we got the at the money contracts highlighted again, just like in our last example. The in the money are on either side of the at the money, and if you're selling in the money, it's right here in this box here, which I depicted right here on the actual chart. If you're buying an in the money, it's in this box right here, and I put it on the chart here. As you can see, in the money, price is trading at this level right here. Right there. Oop. Sorry. Price is trading at this level right here. Okay? Now, all these strikes right here, right? All these strikes right here are above the market. Now, you're selling. You're selling these strikes. So if you're selling, you want what to happen? You want price to expire below your strike. Well, in this case, price is already there. Price doesn't have to go anywhere. It doesn't have to move down. It doesn't have to go sideways. It can even go up a little bit. Okay? And then come back down. As long as it finishes or expires here, below these strikes, you're going to make a profit. Just like on the other side, you're buying these strikes right here, right? All these strikes are right here. They're already below the market. You're wanting the market to finish or expire above them. Again, price is above them already. It doesn't have to go anywhere. Okay? You're going to make money on time decay on these trades. And we're going to talk about time decay, and I'll explain that. Okay? So, on an in-the-money trade, you know, you're going to be selling, say, you sell for $23 up here, okay? That would be the amount that you would make on the trade if it works out in your favor, okay? If price stays below, you would make $23 on that trade. So, the things about the in-the-money is that they require more capital to put the trade up. It's a safer trade, a higher probability trade. It's going to be more expensive to put the trade up, okay? In this case that I just talked about where you would make 23, you would have to put up just over $70 or about 76.25 to make that trade possible, okay? That's the capital required to put that trade up. Stop losses are pretty darn essential here because you're risking a lot more money to do a higher probability trade. And what we do, we set stops at our strikes. I'm going to talk about more about this in just a second. This is the basic outline of the in-the-money I want to get through, and then we'll get more into detail. So take profits I do not use really on these because they really dilute your profits. You know, the stop is essential, but if you're going to use, you can use a take profit. But if you're going to use it, set them at 5 or 95. So if you're selling, you set them at 5. If you're buying, you set them at 95. Again, it's a more conservative, higher probability play. The returns are lower, and you're spending more to make less. So you got to keep that in mind. Now, the skill needed on these is minimal. Why is it minimal? I mean, it's more risk in the trade. Why is it a minimal skill level? Well, the reason is because of what I was just talking about. Price does not have to do anything versus an at the money that we just talked about. You know, an at the money, if you're buying at the money strike, it has to move a direction for you to win the trade. In this case, it doesn't have to. It can just stay right where it is, and that's why these are so great for flat markets. Okay, so you can make money without the market doing anything. So these, you know, being that the skill level is minimal, this is a great place for newbie traders to Nadex to be trading in the money contracts. Okay, so the out of the money, the OTM, The contracts again are located above and below the at the monies, but they're just on the other side of the column now. These were the in the monies. These are the out of the monies. Okay. So these are a directional play as well, and they take even more skill than the at the money because price has to travel further to get to that strike. Like the at the money we talked about, price only needs to go a few ticks to get you into a profitable situation. Out of the money, price needs to travel a greater distance. Okay, so here are all the OTM, or the out of the money strikes. Right? They're right here. You can see that they are above where price is trading. That means price would need to travel up here to get to them, or price would need to travel down here to get to the out of the money ones down here if you sold. Okay? Now, these are much cheaper to do because they're a lower probability trade. Now you can look, here are the buy prices, and I'm going to talk about probability as well in a second. But this, you can buy this trade right here. You know, you can buy the 1.1000. You're saying the price is going to be above that strike at 11 a.m. You can buy that for $6. Now the contracts are $100, right? So 6 minus 100, that's $94 profit potential on a $6 risk. Okay? The only drawback is your percentage of winning that trade is 6%. It has a 6% chance of getting and staying above that strike at expiration. So the probability, lower probability, it's a low probability play. Okay? So that's the reason why take profits are really essential on this. Okay? And you're not going to be holding these trades till an expiration like on an in the money. Okay? You're going to want to take profit and take profit pretty quickly if you get into a profitable situation. There's no stops required on this because the risk is so low. And as we talked about the time decay working in our favor when in the money, time decay is the opposite here. It's against you. Okay? Time decay is going to eat up this option very quickly, especially the closer it gets to your expiration. And if it's not above the strike if you bought, it's going to go against you very quickly. Good thing is your risk is very low if the trade does not work out. Okay, skill required here very high, as I talked about, because price does need to travel a long way. You need to have some good skills in either joining into a trend or whatever whatever you're using, whatever your system is. Okay, so you need some skill to do this one. There's bigger ROI possible. It is a lower probability trade. Take profits essential, as we spoke about, and you're trying to make 1-to-1 again, maybe even more in some cases. And the take profits are you got to be smart with take profits. It's very easy to get carried away with take profits. If you think about it, a 1-to-1, say you bought this for $6, a 1-to-1 would be a $6 gain here. You would want this option to get to $12. It's very easy to get carried away and say, well, I bought this for $6, I want to take profit at $50. Well, that's way out of whack because only a 6% chance of price getting to your strike. So a 1-to-1 is only $12 here. It's a $6 gain. The option would need to get to $12. I'm going to talk about this in a second, but gotta be good about taking those profits and being realistic. I mean, the key word is realistic on those and not get carried away. Okay, so let's talk about the time decay, and this example is about an in-the-money sell. You're selling an in-the-money binary strike here, okay? The red line is your strike, okay? And here is where you're entering the trade. Now, you can see that the price is already below your strike, okay? So you're selling this strike for $25. Keep in mind, contracts on Nadex are worth $100. If you sell for $25, your cost is $75. See, 75 and 25 equals the 100. Desired outcome is for the option to expire worthless or to expire below the selected strike. Okay? So, as you can see, as the time is decaying, as you're approaching your expiration, which is right here, and the time erodes, okay, price is staying nicely below the strike. So if you sold it for 25 and you want it to settle at 0, so you can make $25, which happens here. The price is below the strike at expiration. Therefore, it settles out of the money or at 0. The trader makes the $25. Okay, so whatever you sell the in the money for, the profit potential on the trade, whatever you sell the in the money for is your profit potential on the trade. So you sold for 25, that's the profit potential on the trade, $25. Okay, so your ideal price to sell the in the money is for $25. That would be the ideal price that you will look for on the option chain. Now, are you always going to get that? No. 20 is really the worst you would want to sell for. Okay. There is some other ways that I do break that rule, and that's if I get both sides on. If I get one on here and one on here, which is called an iron butterfly, I may do 15 and 85. But that is a more advanced strategy. I'm trying to go over the basics here of the in the money play right now. Now, on the other side of the coin, we got the in the money buy. It's just the opposite of what we just talked about. You got a strike here. You're buying, so that means you want price to finish above your strike or to finish or settle at 100. Okay, so you buy the strike for $75. Okay, Nadex contracts are $100. If you paid $75, what's left? $25 is left. That would be your profit potential. It costs you $75. Desired outcome is for price to finish above, as we just talked about. Time moves along, it decays, it erodes, and price did finish above our strike. So price is above the strike at expiration, therefore it is in the money and settles for $100. The trader makes the $25. Okay, so if you buy an in the money strike, you need to subtract your buy price from 100 to get your profit potential. So 75 minus 100 is $25. The ideal price to buy is 75. You're looking for $75 on that option chain. Not always going to find it. You can settle for as much as 80. That would really be the worst price you would want to go. Unless we get the iron butterfly on that I spoke about, 85 would be okay. But try not to go too far outside of these numbers here. For your best risk reward. Okay, so I was talking about probability earlier, and I was talking about 6% and all that. So this is the probability in the Nadex option chain. So when you're buying a Nadex option, the buy prices located here indicate the probability of that outcome happening. Okay, so I have a 5% right here in this box. That means if you bought this Euro USD 1.1020 11 a.m. expiration, that means you're saying price is going to be above this strike at 11 a.m. Well, the probability of that happening is 5%. You can buy this out of the money. It's up here above the ATM, right? It's up here. It's an out of the money. Buy it for $5. You have $5 risk on that to make $95. But it's only a 5% chance. That's horrible. So that's really very unlikely to happen, right? Okay, so let's go down here to your at the money. Okay, this is your $51.50. That gives you a 51.50% chance that price would be above that strike at this time. Okay, so it's 50-50 as we talked about. Now down here, look at this one. You have a 99% chance of this outcome happening. A 99% chance of the Euro USD being above 0.760 at 11 a.m. Well, you say, wow, that's awesome. Well, remember, Nadex contracts expire at or are worth $100 or $0. In this case, you're buying, so at expiration it would be $100. Okay, so you go in here and you buy this for $99.25. The thing finishes above. It settles at 0. What did you make? You made 75 cents. You didn't even make enough to cover your fees. Okay? So these are not the smartest of plays. Even though the percentage is so great, that's why you want to be like I was talking about. Excuse me, the $75 range, because then you have $25 profit, built into that trade. Now let's go on the other side of the aisle here, or the columns, and you have your sells. Now, when selling a Nadex option, you have to subtract the option price, $3, from the 100, the total cost of a Nadex contract. So 3 minus the 100 is $97. 97%. So there's a 97% chance of the Euro USD finishing below the 0.980. 97% chance. The only problem is, this is your profit potential, $3. You only have $3 built into that trade. Okay, so it's not very good. So that's why you would want to come down here to like the 22. You have $22 built into the trade. Okay, in this case you would have 22 minus the 100. You have about a 78% chance of that outcome happening. Here we are at the money. This one is actually slightly in the money by $5. So you have a 55% chance. 45 minus 100, you have a 55% chance of Euro USD being below 0.880 at 11 a.m. And the out of the money, you could sell it for 95. Your cost is 5. You only have a 5% chance of price finishing below that strike at expiration. Okay, so setting take profits on the at the money trades that we talked about. If a trade goes in your favor and is nearing expiration, you will notice the option buy to close or sell to close prices will stay around 5 and 95 if you look on the Nadex platform. And this happens until the option expires. Once the option expires, you would receive the full payout. However, it is wise to set your take profits anywhere from 5 to 10 or 95 to 90 on the at-the-money plays, as we talked about in the at-the-money examples earlier in the presentation. Keep in mind, on an at-the-money trade, you only have a 50% chance of your desired outcome. So if price does go your way, take profits when you can. It doesn't pay to sit there and wait out another 2 hours in the trade to make an additional your additional $5 that's sitting there. You know what I mean? So take your profit when you can. You know, I've gotten burned several times with this when I was learning. And you'll learn. I mean, you may do it a few times and then you'll get burned a few times. Take your profit when you can. Okay, so in the money now, and this is a loss prevention, exit at the strike. Okay, so that means you need a stop loss here. Nadex does not offer a stop function. Okay, the in-the-money trades have a skewed risk-reward, as you've seen. You're putting up $25. You're putting up $75 to make 25 on a trade. Okay, 75 and 25. That's not quite 1-to-1. That's well worse than 1-to-1. So that's not very good. You need some type of loss mitigation involved here. So with the skewed risk-reward, because there is more capital required, it's a safer play. The safer the plays, okay, or the more conservative the plays, or the deeper in the money the plays, the more expensive or the more capital you will need to make the trade possible, to put the trade on. Okay, so I would advise you to check out this company called apexinvesting.com. They do offer a subscription-based advanced Nadex ticket, which is called the Stop Trigger plugin. It's specifically tailored for trading on Nadex. This allows you to use the indicative price of Nadex, which I'll explain, for triggers into trades and for stop losses. Okay, you need to set stops at the strike that you select. Okay, this will ensure you get stopped out as close to at the money or 50 as possible. As we talked about, when price is trading right at, say, your strike, what would be the price of that option? It would be close to $50, right? Okay, so if you sold a strike for $25 and you bought it back at 50, or you got stopped out at your strike, which is $50, right? It's a $25 loss. Okay, so and then if you bought for 75 and you got stopped out, or it's sold for 50, you would lose $25. So what you have happening here is you're risking 25 to make 25. See how it brings it to a 1-to-1 now. Okay? So now if you go the next step here and you look at the example, if you do not use a stop here, If you do not use a stop and you lose the trade on an in-the-money strike, you're going to lose the $75 that you put up. That's simply too much to lose, especially when you're trying to make only 25. So we got to keep in mind we really want that 1-to-1 in a worst case scenario. The risk of 25, make 25. Now on the at-the-monies, we don't use stops, but the important factor on the in-the-money, on the out-of-the-money, so the OTM trades, is your take profits. And don't get carried away. Okay, so the example would be to buy an out-of-the-money strike for $15. Now the probability of price expiring above your strike at expiration is only 15%. So you need a take profit since there's not a very good chance of that outcome happening. Okay, so you do not want to let the Nadex ticket obstruct you by displaying that you can make $85 on a $15 investment. So when you pull up a Nadex ticket, on the bottom of the ticket, it tells you, you can make $85 and you're only risking 15. Well, people get this warm, fuzzy feeling and say, wow, I'm not risking hardly anything to make that money. Well, they don't keep in mind that the percentage of that happening is only 15%, which is not very good. So the take profit is essential. So if you buy for $15 and the price of the option goes up to $30, that would be a $15 gain and a 100% return on investment. Okay? There is no need for an out-of-the-money option to get to 100 or even at the money for you to make money on an OTM that you buy. So this example was a buy, right? So you're saying that you want the option to work towards 100 because it settles at 100 if you buy. Okay, but there's no need for the option to even get at the money or up to that strike for you to make money. As price moves up, if it moves up quickly, it's going to change the option price, and that's where you're going to benefit. As I said here, you as the trader are just trying to benefit from a small change in the option price, not for it to expire above your strike for 100% profit in the sense that you're making 85, on 15. You're just looking to make money off a little bit of a change. You have no intention of holding this thing till expiration. You just want to make money on that change. Now this is a summary of what we just went through on take profits and on the ATM, the ITM, and the OTM. So on the ATM, here we are right here, you want to set your take profit at 5 to 10 if you're selling, and 95 to 90 if you are buying. Okay? You will make slightly less than 1-to-1 on ATMs if you use take profits, and it is highly recommended that you do use the take profits. Okay, on the in-the-money, we do not use take profits. You can, but it's not really recommended. And you can set your take profits at 5 and 95 if you so choose to use them. The reason I don't use them is because I do use the stop trigger plugin for stops for the loss mitigation. These are higher probability trades, and the take profits really can dilute your profits. You're already making less because they are safer play. I hate to dilute them even more with the take profit, but you have to use your judgment here. If you see trades going against you, you may want to take your profit out of the trade. Okay, so the excuse me. And the OTM, you're trying to make the 1-to-1 again. You're trying to risk 15 to make 15, or if you bought it for 20, you're trying to make 20. If you bought it for 30, you're trying to make 30. So that's what you got to keep in mind, the 1-to-1. So you can get more creative with your take profits on the out-of-the-money options if you're trading more than one contract. So, for example, if you got 3 contracts that you're trading, you could set one at 1-to-1. You can set one just past 1-to-1, and you can set one a little, or just let one run completely and see if it does finish. For the finish in the money. So you can stagger them. But if you are trading just the one contract, I like to try to get as close to the 1-to-1 as possible. Again, you got to keep an eye on it. If things start to go against you and there's a little bit of profit on the table, pull it off of there. These are just general profit targets. Okay, and I put this together, and the key word here is realistic. Okay, these are realistic take profit targets using the binary option price. Okay, so just quickly on the in the money sections here and here, there is a bunch of NAs because I just talked about we do not set take profits on these usually. So we can skip right over those and get right into the OTM, or the out of the money, and the at the money contracts. Now, this is when you are buying to open the trade or the transaction and selling to close. Okay, so these are your out of the money contracts right here. This particular contract right here, you can buy it for $9. So you're saying price is going to be above there at that time. Okay, $9. So your cost is $9 on this trade. Now, what are we targeting on OTM? 1-to-1 take profit right here, right? So for you to make 1-to-1 on $9, you need to make $9. So the option price is 9. It needs to go to 18. So you would set a take profit order in Nadex on the ticket for $18. Okay? Your profit would be $9. That would be 100% return on investment. You risk $9 to make $9. Okay? Same thing on all these here. Like this one here. Your risk is $20 on this trade, or $20.50 right here. Cost $20.50, right? To take profit, you need to times it by 2, right? That's your 1-to-1. So your take profit, you would put in the Nadex ticket. You want to take profit at $41. Okay? Your profit realized is $20.50 minus fees, of course. You got a 100% ROI on that. Okay? Same thing here. This is getting closer to at the money, but it's still out of the money. $40, right? Your cost is $40. 1-to-1 would be $80. Okay? So that's your $40 profit. Now this is a true at the money one here. It's $51. Okay? If you're buying for $51, your cost is $51, right? Your take profit. Now on the at the money, remember, they're going to be slightly worse than 1-to-1. I told you to take profit at 95 or 90, so I put 90 in here, the more conservative take profit, right? Cost you 51. Take profit is 90. You subtract that, you got $38.25 return, 74% ROI, slightly worse than your 1-to-1 here. Okay, so you put up 51, you made 38. Now on the other side of the coin over here, if you sold the at the money, you sold it for 45. That means your cost, you got to subtract that from 100. Your cost is $54. Okay? And I told you on the at the monies, you want to set your take profits at $5 or $10, and you're going to make slightly less than the 1-to-1. So if this trade does work out, your profit is $35. Okay? There it is. You got 45 right here. Okay? $10 is your take profit. The difference is $35. And it's a 65% return on investment. Now, we talked about the out of the money when you're buying. Let's talk about the out of the money when you are selling. Okay, here's all the out of the money contracts right here. Okay, you're selling this one right here for $57. 57 minus 100, the total cost of a binary contract. Your cost is $43. Okay. If your cost is $43, you're looking to make the profit of $43, right? So how do you do that? And you got to set your take profit at $14, right? There you go. Here's your cost, $32. You're looking to make $32 profit. You need to set your take profit at $36. Okay? And so it goes down the line here. Now you look at this one, it's a $95 contract. Right? Again, this is your low probability. Remember, it's about a 5%er. But anyway, all you're looking to do, your cost on that trade is $4.50. What are you targeting there? You're targeting $4.50. Right? That it was your 1-to-1. That is your 100% ROI. So if you're spending $4.50, you're looking to make $4.50. Okay? So how do you come up with the take profit on that? It's the $4.50 right there, right? Take it off of there, $91. There you go. So that's how you can set reasonable or realistic take profit targets. Now, please take note of this. Okay, the take profits above are general targets. The trader must apply his or her skill and judgment to exit a trade should it turn against them. So don't just sit there and watch, something that's profitable go against you because it didn't quite reach your take profit. If things look like they're going against you, take the profit. Use this as a guide. Try to make this. You're not always going to be able to make your 100% ROI. If you make a little bit less, hey, a profit is a profit. Okay, so I quickly wanted to talk about the Nadex indicative pricing that I talked about, and it's a little bit different for Forex and indices and commodities. I put this up here so you have an understanding how it is calculated, okay? Once you see this, you don't need to remember this stuff. You don't have to do any calculations. Nadex does it all for you. Just want you to be aware of how it works. And the indicative price for Forex is they take the last 10 midpoint prices in the underlying market. They remove the highest 3 prices and the lowest 3 prices. They take the arithmetic average of the remaining 4 prices and round to 1 decimal point past the point of precision of the underlying market. I know, very confusing. As I said, you don't have to remember this. And then on the indices and commodities, they take the last 25 trade prices in the underlying market. They remove the highest 5 prices and the lowest 5 prices. So they're removing the highest 5 and the lowest 5. They take the arithmetic average of the remaining 15 prices and round to 1 decimal point past the point of precision of the underlying market, with the exception of the Wall Street 30, which is rounded to the same point as the underlying market. So that is how the Nadex indicative is calculated. And there is a slight discrepancy in the underlying price and the Nadex and indicative. As I pulled a Nadex ticket here, and you can see this is the Euro USD ticket, and right on the ticket it says Nadex indicative index, and they have it at 1.0875. Okay, if we go to the Euro USD chart, it's trading at 1.08739, so just shy of 0.874, so about 1 tick, a little more than 1 tick. Okay, there is a slight discrepancy there. So if you see that, that's why it is. It's because of how they're calculating those prices with the calculations I just showed you on the previous slide. And that is really it for the presentation. I hope this was helpful for you. Please check us out on the website www.theoptiontradersgroup.com. We're also over at Facebook, www.facebook.com/theoptiontradersgroup. We do post some trades on there and some stuff like that. If you have any questions, we do have a forum on the website, a live trade room where we do some analysis daily on there, and also on Twitter. Stay tuned. We're going to be starting a signal service for some of our in-the-money trades that we do daily, Monday through Thursday. So that is at the Option Trades on Twitter. And again, I hope this is beneficial. If you have any questions, come on over to the site. Post some questions in the forum. Post questions on Facebook or in the live trade room. That's about it.